Hey, it's Jonathan. Thanks for joining me today. I hope this video finds you in good fortune. Today I want to talk about the CPI, or the Consumer Price Index. This is going to be a series of videos that I do covering the fundamentals of the market that I can reference to in future videos, as we're going to be talking about the fundamentals. It's very important. I'm going to talk about the U.S. version of these reports. Every country has their own version of the Consumer Price Index, or something that rivals that. But this is going to be, I'm in the U.S., so I'm going to talk about the U.S. version. I will show you where to find the version that is from your country. In fact, I'm going to be using, this is Forex Factory website. So that's just forexfactory.com. This is actually their FX calendar that we're going to be looking at. But you have up on the right hand side, you can't see it, but up on the right hand side there's well, actually it's right here. This is the filter button. You can go in here and you can filter this for whichever currency or business report that you would like to look at. So you can you can also do this by category here. I have this set up for just the reports that are coming out on a weekly basis, and then focused towards the U.S. The markets, we've recently had a downturn in the markets. And what's happened is the U.S. Federal Reserve has been raising interest rates to counteract inflation, which is one of the methods of counteracting inflation. And the UE came out, the United Nations came out here recently, and they're like, hey, look, stop raising interest rates. Why would the U.S. raising interest rates affect the United Nations or any other countries? The reason is, the answer to that question, the reason is that the U.S. holds the world's reserve currency. What happened is we signed an agreement years ago. We signed an agreement. Our currency is basically backed by petroleum sales, and if you want to buy or sell petroleum, then you have to buy the U.S. dollar, and then buy the petroleum with the U.S. dollar. If you're going to sell petroleum, you have to sell it with the U.S. dollar. So this has created a situation where our currency is the world reserve currencies. There's an old saying that says, whoever prints a currency controls, basically, that's the person that, if you control the money flow, then you control everything. This is not necessarily true, because there's lots of different countries printing lots of different currencies, and just being able to print the currency is not enough to control the market. You have to have a currency that is attached to energy. Energy is really the foundation of the market. It's the foundation of price control, and therefore what's happened is the U.S. has been backed by petroleum. You have to buy and sell petroleum with the U.S. dollar, and this makes the U.S. currency a gigantic player in the market of FX and in the economy in general, not only our economy but everyone's economy, because our dollar is basically the reserve currency of the world. I mean, we've seen stuff that you never thought that you see. The euro is at the euro is basically the same price as the U.S. dollar. The British pound has come down. These currencies are always worth more than the U.S. dollar in the past, but what happened is the U.S. has raised interest rates, which increases the value of our currency, and so all the other currencies compared to ours have come down. In fact, I'm going to show you some of this stuff, but I want to talk about inflation real quick. So we're going to touch on we'll touch on a little bit of a number of things. Basically, the U.S. Inflation reports are our CPI reports. Now, there's some others we'll touch on in other videos, but today we're going to touch on the CPI. CPI is a Consumer Price Index. That's what it stands for. You have the Consumer Price Index. M&M stands for month over month. So this is compared to last month. So the most recent one here on October 13th, we see we're zero point 0.4. We came out at 0.4, which is higher than expected. This was what was expected, and zero point 0.2 was expected. We came out a little bit high. Year over year, we're 8.2% higher in our inflation rates in the price of consumer products. The products that consumers consume were 8.2% higher than we were last year. The YOY stands for year over year. And then we have the core CPI. So the core CPI is basically the core product that consumers consume minus food and energy. It's kind of a distorted picture of what actually the inflation is at. In my opinion, it's a distorted perspective because everybody has to eat, and energy is the base of the economy. Energy is actually everything. So your economy is only flourishing as cheaply as you can consume energy. So when energy comes down, the economy flourishes. On this, the forexfactory.com here, I will link this in the description so you can take a look at your reports for your area or these reports here. You can click on click right there on the little file button, and it will show you. It'll give you a brief description of the consumer price index. It'll give you a history of it. We can go here, and it will show you a chart of what it's been in the past. So we can run this all the way out. You can see when we've had inflation and deflation periods of time. This was COVID here. We had great deflation, went back up into inflation. So, and you see where we're at now. You have actual, so the blue lines are the actual, and then forecast are the little kind of tan gold bars. So that was what it was forecast. So you see in October, the report that just came out, the actual was higher than the forecast amount. So just to give you a overview of that, you can check the latest releases here. This will give you a breakdown. This comes from the Bureau of Labor for the U.S. This is the U.S. report. Let me actually not do that. Let me do. Nope. Let me do this real quick. Slide this over so that you can see it. Okay, so this is the report here. This will actually this is basically this month's release. Again, you can find that right here at the latest releases on the Forex Factory website. And if you scroll down, it gives you a breakdown of what the different items are that are on this report. It will give you a history of what the prices were, so you can take a look at that. You can't see it; it's off the screen. But over here on the right-hand side of the screen, off the screen, when you pull this report up, it'll give you a couple months and then some other figures, so that you can look at. It'll go up to September. I think it's September right there. It describes the different categories that are on the report. So there's your food category, energy category, and it'll give you a brief explanation of what the CPI is. The CPI basically is a consumer price index. It measures the changes in price paid by consumers for goods and services. So I'll let you read this. This is where you can find the information. So I have some notes here we're going to go over real quick. Let's see. Let's go back up here and we'll flip that back. So some of the things that I wanted to talk about here. Okay, so basically, what is the CPI, the Consumer Price Index, explained? Um, so the CPI measures inflation, or what consumers have to pay for products. Inflation is when the price of goods go up, or the purchasing power of money goes down, which ultimately increases the price of goods. So if a country prints a whole lot of money, then there's the money is devalued because there's more money, so the prices of goods go up. That also happens when there's too much money chasing too few goods, so you have there's an imbalance between the money supply and the goods supply. We have three different types of inflation. We have demand pull inflation. It happens when there's a high demand for goods or services, too much money chasing too few goods. So if everybody wants to buy a house for $100,000, for instance, or everybody wants to buy a car for $100,000, or everybody wants to buy, everybody wants to buy a bag of cereal for, $3. Then pretty soon the supply is going to start to shrink because the demand's high, and the price of that item is going to go up because there's too much money chasing too few goods, right? So that's called demand pull inflation. There's a cost push inflation, and you can look these terms up, and I'm just going to give you a brief overview of what these are. There's a cost push inflation. It happens when the cost of products, cost of producing goods go up because of wages or materials. Wages or materials increase. So if the price of materials go up, if the price of wheat goes up, so then the price of the cereal is going to go up that's made from the wheat, or the price of bread is going to go up because the initial core material went up. If wages go up, then the price of whatever that person worked on, labored on to produce will go up because it costs more to make it because of labor costs. So that's called cost. That's called a cost push. Then you have built-in inflation, right? So that happens when inflation, built-in inflation is what happens when inflation stays around for a while and people just simply expect for things to be inflated, so they start charging more for goods and labor. Built-in inflation will create a wage price spiral. Higher wages increase the price of goods, which will increase the price of wages, and so on. So if pay people more to do a job, then uh, that's going to increase the price of the goods sold, and then the goods sold, people need to make more to buy those goods, and that will increase the price of labor, and then you end up in a spiral. The Fed recently came out and they stated that this is what they're trying to counteract. This is why they're raising rates so aggressively, because built-in inflation is what they want to counteract. They don't want people to expect that inflation is going to be higher in the future, or this will spiral out of control. Um, so what we have is we have different types of CPI report, consumer price index reports. I already kind of went over that. M&M stands for month over month. This is U.S. base. CPI Y over Y stands for year over year. Then you have the core CPI, measures inflations without food or energy. Two ways to lower inflation. You can increase supply to meet demand. So the government can do things like, it's called the supply side supply side economics, where say there's an inflation in the price of cereal. Well, then we're going to plant more wheat if that's what we need to create the cereal, so that will increase the supply to actually meet the demand. That's one way to address high inflation. The other way is to create a decrease in demand, to lower increase demand so that supplies prices will be lowered, right? So if there's a less demand for something, then the price will come down because there's less people purchasing it. And this is actually the route that it looks like the Fed is going down instead of increasing supply. At least in the U.S., we have overseas a lot of our manufacturing. We're buying from other countries, so we're highly dependent on other countries for that supply, for the supply chain. And so one thing is, if we were going to do a supply side economics, we could increase the supply to meet demand. The government could make it profitable for companies to start producing here at home, which would increase our supply at home, and then that would probably meet to meet demand. But what the Fed has decided that they're going to do, instead of increasing supply, this is what it sounds like: they're going to just decrease demand. Now, the two indicators that the Fed are looking at is looking at unemployment and the CPI. So unemployment, so if they see the CPI, the consumer price index, continuing to go up with higher and higher inflation, they're going to try to create a situation where people are put out of work. This is my interpretation. You can watch the videos of them speaking, and but this is what basically what they've said, and this is my interpretation of what they've said, is that they're going to create unemployment. We need the unemployment numbers to go higher so that there's less people making money, so there's less money in circulation, which will lower demand and lower prices as well, lower the inflation, because there'll be less demand for the products. How monetary policy controls inflation. There's a couple ways that they control inflation, and also what we talked about here. There are two sectors of the economy. You have the public sector and you have the private sector. The public sector is government and Federal Reserve. You have the private sector that includes companies and just ordinary people, consumers like you and I. So the government control, so the inflation is controlled by the public sector, which is government, and the Federal Reserve. The government controls inflation by increasing taxes or spending less on things like entitlements or infrastructure. This usually doesn't happen because people want to be reelected, and these methods are not popular. So when the government stops spending less, then people get pissed and won't vote the people that are in power back in power. So they're always going to spend on entitlements and infrastructure, right? Inflation is controlled by money. Inflation is also controlled by money leaving the private sector and going back to the Federal Reserve, where it becomes dead money. Okay, so that's how inflation is controlled through the Federal Reserve. Is it needs to leave the private sector and go back to the Federal Reserve. To pull money out of the private sector, the government can issue bonds. So when bonds are issued, basically bonds are like IOUs. You can purchase bonds. That money, you purchase the bonds from the government. That money goes back to the Federal Reserve and becomes dead money. When you buy a bond, when when you buy a bond, the purchase price goes to the Federal Reserve, and the money is taken out of circulation until that bond is paid back with interest. So it does ultimately come back to you, but it initially takes the money out of circulation by buying a bond from the government. It goes back to the Federal Reserve. It becomes dead money. The Federal Reserve will also increase interest rates to fight inflation. So when interest rates go up, the private sector borrows less money. You're more likely to borrow at a 2-3% interest rate as a 12% interest rate. So when interest rates go up, the private sector borrows less money, which decreases the amount of money in circulation. Also, as interest rates go up, it encourages the private sector to pay off their debt. When they pay off their debt, the money flows back to the Federal Reserve as dead money. So when you pay off your debt, the money goes out of circulation. It goes back to the Federal Reserve, and therefore it's not in circulation. Also, that interest that you pay on that debt, that's more money flowing out of there. As interest rates go up, that's more money flowing out of the economy. So central banks will also increase the reserve rate for banks, which will make them hold on to more dollars, restricting the amount of currency the private sector has to spend. So when the reserve of the banks is increased, then they need to hold more dollars for their deposits. They have to hold a percentage of when you put your money in the bank. Say you put $100 and the reserve rate is 10%, then they need to hold $10 back and actually keep it in the bank in case you want to withdraw your money. Recently, that the reserve rate went down to basically zero. They didn't have to hold back any of the money that you put in. They could lend it all out. But so what happens is the central banks will increase the reserve rate for banks, and so the banks actually have to hold on to more money. So these are ways that monetary policy affect the CPI, the Consumer Price Index. But not to get too far off the point, the Consumer Price Index is what consumers pay for a good or a service. So for a product or a service. I want to just make one little point. We are looking at, I don't want to get into too much technical analysis, but I did want to bring your attention to the repo market, the reverse repo market, which I've been watching very closely. As opposed to purchasing bonds, the banks can put their money into hedge funds and stuff can put their money into the reverse repo market, which is basically an overnight place where they can store their money and receive interest on it. And I tell you the truth, if you look at this, this is where a lot of the money is being hid right now. I'm watching this very closely because we have a whole lot of money just sitting on the side, and it's with the reverse repo market. So that's something to consider as well. When all this money comes back, you think, oh well, the Fed will have to lower interest rates for money to come back into the market. Well, we have a lot of money sitting on the side, and so even if the Fed does not start putting money back into the economy, there's a lot of money sitting on the side just waiting to come back into the economy. So we're watching this very closely as well. That's something I want to bring to your attention, although that does not have anything to do with the Consumer Price Index right at this point. Okay, so look, I hope this video helped you. I hope it was clear, and if you have any questions, just leave them down in the bottom. If you like to buy the bottom and sell the top, make sure you give me a like, subscribe. Watching the video all the way to the end helps. Give me a comment, really appreciate that. Share the video. And that's just about it for the CPI. So y'all are beautiful. I will see you next time.